I want to buy a house, but I don't know what it takes. Can you help me? Yes, I can. Pay attention for the next 3 minutes. Hey, it's Ryan Charles. Welcome to the Loan Giants Daily. It's Tuesday, January 25th, 2011, and today we're talking about what it takes to buy a house in this market. Now, it's a moving target nowadays. The market's changing quite a bit, and so we're going to go back to the basics and discuss a few things, what it takes to buy a house in this market. Any realtors that get a hold of this message, save it in your inbox. You're going to need it. Forward it to your clients. It's going to save you a lot of time and energy trying to explain what it takes to buy a house today. Now, this whole process can get really confusing, but if you really break it down to the basics, there's only 3 things that go into getting approved for a loan. First thing is credit score, and that's black and white because that's a hard number. Second thing is loan to value, and we're going to talk about that in a minute. And the last thing is debt to income ratio. Those are the 3 things that you need to know about. All right, let's talk about credit score. You start off, the low end is about 350, high end is 850. Majority, I think the average credit score in the United States right now, they say, and you're going to read different reports, but I believe it, it's somewhere in the 680 range. Anything above a 740 is considered a very good score. So your goals would be a 740, and in fact, a 741 and an 849 are in many cases considered the same score. The important number you need to know when we're talking about credit scores is in this market is 640. That number a few years ago used to be as low as 580. Those are gone. It went to 620, and pretty much those are gone now too. 640 is the basis for where you want to be to qualify for a mortgage loan when it comes to credit score. If you're not sure what your score is, go to my homepage, look on the left part of the links, go to annualcreditreport.com, and I actually did a daily about that a few weeks ago. You can see it in the archives. All right, moving along. Let's talk about loan to value. Well, when you're buying a house, loan to value is simply how much money you're putting down on your home. That's going to be expressed as a ratio, sales price versus loan amount. So loan to value in an FHA example, which is what we're going to talk about today, is 3.5% is the minimum that you have to put down nowadays. So you're looking at a $200,000 purchase, you're looking at about $7,000 down. What I like about FHA in this market is in the local area, in the local Richmond MSA, our FHA loan limit is $535,900. A lot of people don't realize that because FHA traditionally has been there to help people get into homes. You can get a loan all the way up to $535,900, a loan, not a sales price. So what I like about that is with 3.5% down, you're going to get into a lot of homes in Richmond. Another thing I should mention about FHA, and down payments especially, is that 3.5% you get can be gifted to you by a family member. So if you don't have that money, you can get that money from a family member simply by writing a gift letter that's signed off by both parties. It's pretty common in this market. All right, so now you know your credit score and you got a 640 or above, and you know your down payment amount. You got to have at least 3.5%. Let's talk about the last moving piece, and that's debt to income ratio. Now, underwriters are going to want to see a 2-year work history minimum. So you're going to want to be able to explain where you've worked and no gaps in employment ideally. If you have had gaps, you might have to have a letter explanation. Your debt to income ratio is simply a ratio of what you got coming in per month versus what you got going out per month. Now, when you're calculating your debt to income ratio, the only thing they're really looking at is installment loans and revolving trade loans, and of course mortgages. So if you have a mortgage, a car loan, a student loan, unsecured personal loan, and all revolving trade lines, those are all going to be a piece of your debt to income ratio. Things that aren't going to be part of your debt to income ratio that people often confuse would be something like insurance, something like utilities, cell phone bills. These things are not part of your debt to income ratio. I know, debt to income ratio is the most confusing of the 3 things we talked about. If you're not sure what is included in your debt to income ratio, pull your credit report on annualcreditreport.com, analyze what's on there, and that's what they're using. If it's not on there, they're not using it. What I usually suggest to buyers is that they create a budget and they understand what they can afford, because a lot of times you're going to get approved, especially if you have good credit scores, you're going to get approved for more than you're probably wanting to spend. So that magic debt to income ratio number, that number that you're going to be looking for to be under, to get approved, that is going to be the 50%, 55% range. Again, that's pre-tax dollars. That's what you got coming in divided by what you got going out each month. So there you go. It's just that simple. I know we covered it quickly. If you got more questions, please call me. 804-744-3600 in my office. All my information is right here. And if you like what you saw today, please subscribe to my emails. They come out every day. There's going to be a new video talking about something completely different tomorrow. Please post this on Facebook and forward it to someone who you think could benefit from this information. It's Ryan Charles coming to you from Lone Giants Daily. We'll see you tomorrow. I know it was a boring one today, but people need to know this stuff. Friday's Fun Day is coming soon enough. Stay tuned.